Welcome back. You're still on Finweek Money Matters. Remember, this is the show that helps you manage your finances. The property sector has not been immune to the change in the economic climate as the Reserve Bank hikes interest rates and financial markets remain volatile. This causes shifts in investors' approach to the property sector. But joining us to discuss the market outlook for the property investment is John Loos, F&B property economist, and Professor Francois Viruly. He's a property economist and associate professor at UCT's Construction Economics and Management Department. Prof, let me start with you right there in Cape Town. If we look at the property sector in general over the past year, how are we faring so far?
I think it's always an issue with the property market, and when you look at it, that you have to segment the market. To talk of the whole property market doesn't really give you the right feel. But nevertheless, I would argue that we are seeing a property market that is largely in balance. I think we can talk about it. I think there's certain supply and demand factors at play at the moment. But generally, we are seeing a property market that is keeping up just above the inflation rate. But still, we're far away from the sort of property market that we saw in 2003, 2004, 30% increases in prices. But I remain enthused by the performance of the market. And I think really the other important thing is, of course, when we speak of the property market, we've got the residential and the commercial side. We've had problems with operating costs in the commercial side of the market, but we're really seeing an industry that is managing to keep costs under control at the moment.
John, let me come to you. Prof was talking about the property sector. How are we doing in terms of it being able to keep up? It's currently above inflation, as you heard. And I said, you've got to separate between residential and commercial property. Your analysis of this particular sector?
Well, yeah, I follow residential more. And what we're seeing is I think, moving towards some sort of slowing. At the moment, it's more like slowing growth. House prices are still inflating slightly in real terms, but are down on last year's 7% average, or inflating slower. Volume growth in terms of transactions isn't what it used to be. And if you look to the commercial side, I seem to remember the IPD's total returns for commercial property last year being slightly slower than the year before, which I think is a sign of things to come there too. The reality is, residential or commercial, it doesn't matter. It's got to reflect the economy to a large extent. And we've had an economic growth rate that has slowed for 3 consecutive years, up to 2014. And it could be another slow year this year, it's possible. So we're not really going places fast as an economy. And of course, interest rates are rising too. So I think we do need to see some sort of tapering off.
Prof, you heard economic growth rates not where they used to be. And of course, we do have to take into account that interest rate cycle that's coming in. Are these the very key factors that we need to keep in mind before we delve or start investing in the sector?
Yeah, look, I think that the state of the macroeconomy will continue to play a very critical role in this. When we have an economy that is struggling the way it is, invariably it starts impacting on the balance sheets of households, their ability to enter the market, insecurity of income. And you must remember that we also have an approach at the moment that quite a number of households are finding it difficult to secure bonds in this market, it's certainly in particular sectors of the market. And then we have a property market that has become, I would say, sensitive to interest rates movement. If we look the last few years, it's a property market, if we can use the word, bobbing around to some degree. Every time we have a shift in interest rates, it does impact on the performance very much. So I think we really have a market that will be looking very carefully at what the Reserve Bank will be doing next. But then again, I think there's some interesting work which my co-panelist has done on recent figures on the township market. Very good performance in that market. He's got the figures more than I have, but it really shows that the market is not moving in a unilateral fashion, and there's some really important differences.
Let's pick up on those figures for the township markets, and also looking at South Africa's cities. Where are we seeing a lot of investment going?
Well, I think, yeah, that's whether it's going there or whether it's going to go there. When the cycle is against you, the bigger macro cycle is against you, and I think it is against us now. You can't just buy any old thing and make money out of it like you could a decade or more ago. Then you've got to be clever. You've got to look for the big structural changes that are taking place in your economy. And, we're obviously urbanizing. So that points to urban property probably going to outperform, in the major cities, outperform the more rural property markets or the holiday property markets. It's a financially constrained environment, so it's about essentials. Operating properties is becoming more costly with the rates and tariffs bills and so on. So it's about less frills and luxuries, less swimming pools, smaller stand size. Smaller is better generally, higher density. And then I think as time goes by more and more, and you're probably seeing it around the Gautrain corridor already, but it's higher density near to good public transport, because we're also getting more congested as time goes by. So those, I think, will more be, as we go forward, will be more and more the themes, and that's where we have to be a cleverer investor to make money in property now. As I say, you can't just do it all over the place, and you've got to look for those big changes, public transport shifts, densification, urban essentials, affordability, smaller, etc.
Prof, we can't just be doing it all over the place, and that is what... just pick up, I know you've got a comment on that, and then I'll just jump in. Just a comment on what John has said.
Yeah, I think he makes two important points. And first of all, as I've often said, in South Africa, we've delivered houses on the 40 by 40 by 40 basis, 40 square meter house, 40 kilometers away from where you live, where you spend 40% of your income on transport. And this very issue of densification becomes critical in that respect. If we can get people closer to their homes, it has an impact on affordability. In other words, reduce the amount people spend on transport from, let's say, 40 to 20 and get them into these properties. So I think those linkages with public transport, transit-oriented developments, how we handle that, where we locate property, has an impact on affordability beyond just the price of property. So I think this is something which we're seeing an interesting trend on. And the other thing which we may want to talk about is that we're moving into a new era where we are seeing, for example, the listed funds in South Africa entering the residential property market. In the past, our REITs, our real estate investment trusts, were largely based on commercial, and I think that's the important change we're seeing. So we're starting to see some serious private sector money, but those houses are going to be very different. This is not going to be your 40 square meter house down the road. It's going to be big, high-density developments.
Prof, I'm going to come back to you regarding those listed property sectors, but John, we're speaking about trends, and densification is one thing that definitely came out very strongly here. What about moving offshore as one of the trends? It seems to be in almost every magazine or every article saying that people are just going offshore, and that's where the growth is, and in particular, Europe.
Look, I'm not well versed in all the offshore markets. I look at South Africa, but I think one has to be a little bit careful. Well, firstly, it's not a great time from a point of view of the rand is very weak. 5 years ago, it would have probably been a lot better. But okay, you can't cry over spilt milk. It's not a bad idea to diversify some of your portfolio offshore, be it shares, property, whatever. But then I think we have to be careful as well. There are a couple of rather bubbly looking markets overseas as well where you may not want to invest. I understand Australia is possibly one of them. The London market looks pretty heated. So it may not be a good buying opportunity in some of those. What perhaps people should start looking at is some of these economies where there's been quite a lot of trouble and turmoil. And you think of Greece, somewhere along the line, where does Greece hit rock bottom, and can you pick up bargains there? I'm not sure, and I don't pretend to know all the answers, but perhaps the instinct is often to look straight away at these markets that aren't in trouble and that are really pumping, and possibly a lot of them are a little bit overvalued or have overshot the mark a bit. So one needs to be careful on that side.
We'll come back to, in South Africa, what's the best way to possibly go in. Prof, I said I'd touch with you on those listed properties. We were just talking about offshore markets, the likes of NEPI being listed and said to be doing pretty well. Just how are we doing if you relate the properties that are listed in South Africa versus ones that also have exposure to offshore?
Yeah. Look, I think that the REITs that are invested offshore have shown a very strong performance. I think they've really seen I suppose, the benefits of, or if you can call it that, of a depreciating rand. They are, and quite a number of our funds are sitting in Australia, they're sitting in East Europe. And I think what's also becoming interesting, quite a number of our funds are looking at the rest of the continent at the moment. Yes, I think the appetite for emerging markets has maybe decreased a bit over time. But I think those funds that have had that foreign exposure have shown a very strong performance. Look, I think the other interesting thing is that the listed property funds in South Africa at the moment are trading, I think, on average about 10% above NAV. And yes, there is a view of saying how far more can we go with that sector based on, as you rightly indicated, the poor fundamentals that we're seeing in the market. Ultimately, the property sector has to reflect the fundamentals of the property market. So I think we're also seeing a dual market at the moment. On the one hand, you have your unlisted properties that are performing so-so, and you have this absolutely great performance of the listed sector, which also benefits from the noise in the equity markets and so forth, and their exposure overseas.
So, John, just to close this off, the best way to do this, the best way to invest in property in South Africa at the moment, if I'm not very well versed in what the property sector is doing, what would be your piece of advice here?
I think if one's not very well versed, and if you aren't skilled or don't want to be skilled necessarily in managing tenants, because that isn't everybody's passion, obviously the emergence of residential listed funds, the commercial ones have been there all along, although they may not be such a good buy opportunity at the moment because they have been running hard. But the emergence of listed funds on the residential side, that starts to give you choice. It's you're diversifying your risk essentially when you invest in a fund, because they've got a hoard of properties and they've got a management team to manage the tenants possibly better than you can do as an individual landlord. So the listed sector is obviously the way for the less well-versed people to do it. But at the moment, good buying opportunity. Well, in the commercial listed space, I'm not convinced. Again, it's one of those things. You get the cycles, and you've got to a stage where it's run quite hard, and we're in a slowing economy, and that's got to take its toll, I believe, on the sector.
I'll just getting closing comments from you, Prof, there in Cape Town. You've heard what John has to say in terms of the best way to enter this particular market and what you need to consider. What should our viewers be taking away from you?
I think there's a real opportunity in this market, and I think John made the point of saying, I think we're seeing a growing rental market, and it may well be an option for certain people to say, I'm going to rent, but I want to see the capital appreciation that I don't get out of the rental market. And I'd like to pick some of that up in the listed property sector. And again, if you're not versed in the sector and you don't want to get the phone call on a Friday afternoon that the geyser has gone, it's not a bad sector to be in. It's shown a strong performance. I would say it's a bit on the expensive side at the moment. But you know what? At the end of the day, I'm still of the view, get yourself into property, even if it's a small unit at this point, which you may not live in for the rest of your life. Still, it offers an investment opportunity.
Gentlemen, thank you so much for that insight. Thanks so much to my guests, John Loos, F&B property economist, and Professor Francois Viruly, property economist and associate professor at UCT's Construction, Economics and Management Department. That's it for this edition of Finweek Money Matters. Remember that you can go and get yourself a copy of the magazine. It is available on your shelves, but also available online. From myself and the team, we'll see you again same time next week. Have a great weekend.